Hey, welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network, and you can subscribe to all of our terrific podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Friday, October 11th. And joining me, as always, the resplendent Dr. Orphe Divounguy, PhD economist. Dr. O, we talk a lot about mortgage rates on the show.
Yes.
And we've had a lot to talk about in the last three years. I mean, and actually, if you wind it all the way back to 2020, I mean, mortgage rates were, sitting around 2.5%. They've gone up as high as, I don't know, I think the highest that I saw at Freddie Mac was maybe 7.2, 7.4.
Totally, yeah, big jump.
When the Federal Reserve cut the rate in its most recent decision, mortgage rates responded, or I should say the market responded with mortgage rates that fell down to nearly 6%. I think the lowest I saw it was 6.05.
Yeah.
But they've bounced back up. Freddie Mac, looking at it today, 6.32%. And this is, of course, this is blended average, right? 6.32%. So while the economy seems to be chugging along nicely, as you like to say, that rates are forward-looking, and they are. I mean, it's business, right? I mean, it's interpreting data yet to be tabulated.
I mean, ultimately, investors want to place bets that make them money. They want to put themselves in the best position to make money. If you got a strong economy, then you want to make sure you're invested to get the highest possible return.
Right.
Right. And so if you got a lot of growth and you're putting your money under a mattress, you're essentially losing money. And so remember, investors flee to the treasuries and, and kind of mortgages even, because they're kind of safe. They're safer, guaranteed returns essentially. And, but they do that. They're only going to do that when they think economic growth is slowing or that there is the potential of a recession is increasing, right? They're like, okay, I'm going to go and guarantee myself, lock myself in, guarantee myself a return, even in a period where there's not likely going to be a lot of economic activity. And so that's where it's going to, my money is going to be safe there, right? In fact, we call that kind of in the econ lingo, the risk-free asset, right? Is the idea that you get yourself a guaranteed return by lending your money to the U.S. government, and so that's what investors do. But when there's growth out there, so for example, when the latest jobs report comes in way above expectations, and productivity numbers are ticking higher, and the Atlanta Fed GDP now shows 3.2% growth in the third quarter. If you put your money under a mattress, you lost money. And so that's what we always tell people: stay invested, right? And so basically, you have people going to say, hey, hold on a second, stock market's clocking new record territory. I don't want to be on the sidelines. I want to make the money. I gotta enjoy some of that. And so basically you have money chasing those gains and yields, right? The price of treasuries goes down and yields go back up. And that's exactly what's going on right now. The economy is strong. Wage growth is strong. Households budgets are improving as wage growth remains elevated and headline inflation continues to ease. All of that, right? All of that together is why yields have gone up, mortgage rates have gone up, and essentially, if you were a first-time home buyer, the time was you had like the perfect time. I wrote about it extensively.
Mm-hmm.
Perfect timing to jump in. It was you have lower rates, higher inventory relative to last year, so more options, and so perfect timing to jump in if you're a first-time home buyer. And if you were just a homeowner who bought last year at much higher rates, the time was now to refinance, and I hope you did it.
Well, it's still not a horrible time. I want to.
It's still better than last year, for sure.
Yeah, right. And to fact check the number that I sort of winged out there, a year ago at this time, and this is straight from Freddie Mac. So in October of 2023, the FRM averaged 7.57%. So if you bought a house last October and you closed with a rate that's in that ballpark, again, that's a blended average based on your scores.
Look,
you're still a point and a quarter.
Yourself.
Well,
I'm glad you fact checked yourself,
lower.
but I gotta say you weren't wrong. Okay, like if you look at Mortgage News Daily, those things are extremely volatile. They move up and down so quickly.
Yeah,
you were in the ballpark, so I wouldn't call that a fact check. I think you were correct. You were right.
It's a clarification. I want to get the number right.
The bottom line is mortgage rates were more than a full percentage point higher than they were a couple weeks ago.
So the point I was trying to make is, like, everything's relative to your own personal situation.
That's right.
If you bought a house around a year ago and you got a rate that was above 7, and if it was closer to 7.5, and now if you can get a rate at 6.3% or somewhere in that ballpark, you're going to save yourself a bunch of money.
Even 6.6%, right? So like I have a colleague who wrote a piece a couple of days ago that says, look, for those borrowers who bought in 2023 at a mortgage rate of 7.6%, refinancing at a 6.6% rate, today's rate, essentially, according to Mortgage News Daily, could have saved them an average of $391 per month or $23,000 over the next 5 years, right?
Yeah,
and
why not?
We're talking about like the typical home value across the country, mortgage rates, so I mean, look, the bottom line is there were more than 434,000 home buyers in 2023 would have likely benefited from a refinance last week when mortgage rates was 6.1%. And with rates having shot back up to 6.6%, less than 160,000 home buyers would have, it makes sense for less than 160,000 home buyers to refinance today.
Mm-hmm.
Those people who bought last year. So that means 275,000 borrowers could have missed out on the potential refinance savings. A total 5-year loss of more than $6 billion when you combine it for all those homeowners. It's a lot. It's a lot. Well, now, luckily for you, rates are going to fluctuate around this range. I've said it along. If we get 5.9%, we're really lucky. But they are likely going to fluctuate around this range, and hopefully not climb back up very much, especially in a rate cutting cycle. The Fed is cutting interest rates. Short-term Treasury yields will come down. Mortgage rates are expected to remain in the range, maybe ease a little bit. If we avoid a recession, the spread between the 10-year yield and mortgage rates is likely to shrink a little bit. We're going to get a little bit of easing if we're lucky from where we are right now, if we're lucky. But at least we're not going to see them climbing up and up and up. At least that's my hope.
Well, I appreciate your thoughts as always. For Orphe, Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.